Candlesticks. Every candle on the chart tells a story, but most traders don't know how to read it. Candlesticks show you price movement within a specific time. Each candle has 4 parts: the open, the close, the high, and the low. If the candle closes higher than it opened, it's bullish. If the candle closes lower, it's bearish. The 3 most popular candlestick patterns are: 1. Doji. A doji forms when the open and the close are almost the same. This shows indecision. Buyers and sellers are equal. After a strong move, a doji can signal a possible reversal or pause. The engulfing candle. An engulfing pattern happens when one candle fully covers the previous one. A bullish engulfing shows strong buying pressure. A bearish engulfing shows strong selling pressure. This often signals a shift in control in the markets. And number 3. Pin bar. A pin bar has a long wick and a small body. It shows that price was rejected strongly from a level. A long lower wick, buyers stepped in. A long upper wick, sellers stepped in. Fair value gap. Most traders chase the market, but smart traders wait for the fair value gap. A fair value gap happens when price moves so fast that it leaves an imbalance in the market. You can usually see it as a 3-candle pattern, where the middle candle is very strong and leaves a gap between the first and the third candle. Price often comes back later to fill the gap, because the market wants to rebalance liquidity. So instead of chasing the move, traders wait for the price to return to the fair value gap zone. When price enters the zone, you watch for a rejection or confirmation, and that's where the opportunity appears. This is one of the most powerful concepts used in institutional trading. Elliott waves. Market doesn't move randomly. It moves in predictable waves. This concept is called Elliott wave theory. The market moves in a cycle of 5 waves in the direction of the trend, followed by 3 waves in a correction. Traders try to identify where the market is within the wave structure. The strongest move is usually wave 3, where momentum is highest. Many traders look to enter during wave 2 or wave 4 pullbacks to catch the continuation of the trend. Understanding Elliott waves helps you see the market as a structure, not randomness. Support and resistance. The market respects certain levels over and over again, and most traders ignore them. These levels are called support and resistance. Support is an area where price tends to stop falling and move higher. Resistance is an area where the price tends to stop rising and move lower. These levels form because traders consistently buy and sell at the same price. Typically, a level becomes more reliable after at least 3 clear touches, confirming that the market respects the zone. How to trade it? When the price approaches support, traders look for buying opportunities. When the price approaches resistance, traders look for selling opportunities. If a level gets broken, it can flip its role. Support becomes resistance, and resistance becomes support. Mastering support and resistance helps you understand where the market is most likely to react. What if the market followed precise geometric patterns before reversing? Harmonic patterns are structured price patterns based on Fibonacci levels used to predict potential reversals. Common patterns include the Gartley pattern, the bat pattern, and the butterfly pattern. Each pattern forms with specific Fibonacci ratios, creating a high probability reaction zone. Supply and demand. The market doesn't move randomly. Price moves between areas where big institutions buy and sell. These are called supply and demand zones, also known as order blocks. A demand zone forms when a strong buying pressure pushes the market higher. A supply zone forms when a strong selling pressure pushes the market lower. These strong moves often happen because large institutional orders enter the market. Usually, an order block forms at the beginning or in the middle of an impulsive move. It often appears as a small candle followed by a strong large candle, showing where institution entered the market. When price returns to a demand zone, traders look for buying opportunities. When price returns to a supply zone, traders look for selling opportunities. These areas are important because they often act as key reaction points in the market. Momentum. Price isn't everything. The real question is how fast it's moving. To understand the momentum, we can use an indicator called MACD. It measures the relationship between two moving averages, helping you understand trend direction and momentum. You will see three things: the MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, it's a bullish signal. When it crosses below, it's a bearish signal. The histogram shows momentum strength. When it's growing, momentum is increasing. When it's shrinking, momentum is slowing down. MACD helps you stay aligned with momentum instead of guessing entries. Fibonacci. The market doesn't move randomly. It often retraces to specific levels before continuing. Fibonacci is a tool that shows potential pullback levels in a trending market. The most important levels are 38.2, 50, and 61.8. These are areas where price often reacts before continuing the trend. To use Fibonacci, first identify a strong bearish move. Then draw Fibonacci from the high to the low. Wait for the price to retrace into one of the key levels. At that point, look for confirmation to sell, as the trend is likely to continue downward. Divergence. When the price is moving in one direction, but the market is telling a different story. When price makes a lower low, but the indicator, ultimate oscillator, makes a higher low, this is a bullish divergence. It signals that selling pressure is weakening and price may move higher. When price makes a higher high, but the indicator makes a lower high, this is a bearish divergence. It signals that the buying pressure is weakening and the price may move lower. Break of structure and change of character. The market leaves clues before every move. You just need to understand the structure. Break of structure means the trend is continuing. For example, in an uptrend, price breaks a previous high or a low. Change of character signals a potential reversal. It happens when the market breaks structure in the opposite direction. Breakouts. The biggest moves in the market happen when price breaks out of a range. Breakouts occur when price has been consolidating and then suddenly moves with a strong momentum in one direction. This usually means that buyers or sellers has taken control of the market. The longer the consolidation, the stronger the breakout can be. How to trade it? Traders wait for a strong move outside the range, showing clear momentum. Some enter immediately on the breakout, while others wait for a pullback to the breakout area for confirmation. The key is to follow the momentum, not fight it. Breakout trading helps you catch the market when it's moving fast and Heikin Ashi. What if you could make the market look 10 times cleaner and easier to read? Unlike normal candlesticks, Heikin Ashi uses averaged price data, which smooths out the chart and removes noise. This makes trend much cleaner and easier to read. A series of green candles with little or no lower wicks shows a strong uptrend. A series of red candles with little or no upper wicks shows a strong downtrend. As long as the candles stay consistent, the trend is strong. When the candles start getting smaller or shows wicks on both sides, it can signal weakness or potential reversal. Gann Angles. Most traders draw random lines, but this method uses precise angles to map the market. First, you mark an extreme low and an extreme high using horizontal lines. These levels define the key range of the market. If you're looking for buying opportunities, you focus on the extreme low. From that low, you draw a 45-degree angle, which represents a balanced trade. Once the 45-degree line is in place, you apply the Gann fan. From that same point, the fan creates multiple angles that act as dynamic levels. As long as price stays above the 45-degree line, the market remains strong. If price breaks below it, momentum may be shifting. Price will often move between the different angles of the fan, giving you potential entries and reaction zones. Moon cycles. What if the market is influenced by something traders never look at? The moon. The moon cycles are based on the idea that financial markets can be influenced by natural cycles, including the phases of the moon. The two key phases are the new moon and the full moon. These points are believed to correlate with changes in market sentiment and turning points. I do not recommend using moon cycles. Renko chart. This chart type shows pure price movement and most traders don't even know it exists. Renko charts are different because they don't use time like traditional charts. Instead, a new brick is only created when price moves a specific amount. This means small fluctuations are filtered out, making the trend much cleaner. How to trade it? When a series of same color bricks appear, it usually signals a strong trend. Traders often enter when a new brick confirms the direction and stay in the trade while the bricks continue forming in that trend. When the color changes, it can signal that the trend is weakening or reversing. Renko charts are powerful because they help traders focus on pure price movement instead of noise.